The trajectory of interest rates and the expectation of where they could go in the future provides the basis for much of the price action you see within financial markets. And with that in mind, let's take a look at what markets stand to benefit at a period of time when we see interest rates being cut. So first and foremost, here's a look at the US dollar. Now, by and large, as we see here in the past, it's not necessarily been super clear cut. As we see these vertical lines I have here highlight periods of time where we've seen the inception of a new rate cutting cycle. And generally, it hasn't always been the case that we see gains for the US dollar or weakness for the US dollar. And this really leads us into the conversation that we have to have about the idea that not all periods of easing are made equal. Certainly, some periods we will see rate cuts out of desperation, where we see the economy collapsing and the likely inception of a major surge in terms of unemployment. And therefore, the Federal Reserve needs to act fast. Now, bearing in mind, on those occasions, you're likely to see some strength in terms of the US dollar, because the US dollar, of course, is perceived to be a haven. Generally, you might see the US dollar outperforming prior to that as well, because we, of course, see markets realizing what's ahead. And you generally will see the data starting to turn prior to the Federal Reserve actually taking actions to try and stimulate the economy. But certainly, as we've seen here, the trajectory for the US dollar in itself isn't necessarily that clear cut. Now, we can, as we see here, look towards some of the emerging markets. And certainly, as the example that I have within this chart, which is the US dollar against the Rand, the South African Rand, you can see here that generally the long-term trend is strength for the dollar, but weakness in terms of the Rand. But if you look in terms of periods of time where we see interest rate cuts, what do we typically see? Well, we typically don't necessarily see an instantaneous period of strength for the Rand. And that's because if you look at emerging market currencies, generally they're perceived to be risky, right? They might carry with them the benefit of higher interest rates compared to some of the more developed nations. But that benefit is outweighed by the risk at a time when you see a global economic crisis on the cards. And that's why, if you look at this chart, the inception of the interest rate cut is not generally the time where you see outperformance in terms of emerging market currencies. Instead, you see that risk off play benefit in the US dollar. We've seen after each of these three occasions a surge in terms of the US dollar against the Rand. And what happens after that? We then see, following the topping out of the unemployment rate, as you see at the bottom, once we see that unemployment rate topping out, that's when people start to become a little bit more confident that perhaps the worst is over. And so we're heading in the right direction. Now, certainly there is a benefit, as we see with these periods of time in terms of rate cuts from the Federal Reserve. There's a benefit to having your investments in some of these other markets, because they do provide a greater return. But you want to see that the worst is over, because at the time where we're seeing a ramp up in terms of unemployment in the US, that's certainly a time where people do not feel super emboldened about the idea of investing in more left field assets, in so-called riskier assets, and therefore they hunker down into those sort of safe haven plays, the likes of the US dollar. But when we see the likes of the unemployment rate topping out, that's where we start to roll over. The example of where we are at the moment is that we've seen unemployment potentially bottoming out, but we haven't necessarily seen a surge. And therefore, if we do see a surge in terms of unemployment, you're likely to see the US dollar continue to strengthen against emerging market currencies. The caveat to that is, if we don't see that unemployment rate surge and we see the economy retain with a sort of soft landing environment, there's an expectation that you would then see dollar Rand rolling over, and the same kind of thing for some of the other emerging market currencies. Precious metals has been something that I've been telegraphing for years. Quite frankly, anyone that follows me will know that the likes of gold, the likes of silver, it's been a really clear-cut trade for this period. And that's because, by and large, if you look back in terms of the history of gold, you'll be able to see that the periods where we see the inception of a rate cut, certainly over the last 20 odd years, we've seen those rate cuts line up with periods where we either see a bullish breakout following consolidation for gold, or we see a continuation of a bullish trend. Where we are at the moment, at the time of recording this video, of course, we're at record highs. And part of that might be due to the fact that it's been well telegraphed that we will see rate cuts. Of course, many of the rate cuts through history come as somewhat of a shock. You'll see suddenly a crisis will emerge. Retrospectively, everyone will say that they could have called it, but at the time, few people might have called it. And in which case, it sneaks up on you. All of a sudden, you've got a crisis on your hands and you have to deal with it. And the Federal Reserve do deal with it. And generally, that will take the form of cutting interest rates or quantitative easing. And that kind of thing points towards a potential devaluation of a currency. And it points towards the potential benefits for non-fiat assets. And therefore, when you look at the likes of gold and by proxy silver as well, which generally is the more volatile of the two, bear in mind I've put this on a logarithmic scale on the top to sort of show you the sort of trajectory in greater detail, because it can get lost over long periods of time. You can see here that generally gold and silver do very well in periods where we see easing in terms of monetary policy. That can be on the QE side of things, that can be on interest rates side of things. But certainly as rates roll over, by and large, by historical standards, we do generally see gold faring well. And I wouldn't necessarily say that this is a case of a haven play, because generally in the past, when you see interest rates being cut, that's the time where you see, as you see at the bottom here, that's when you're seeing unemployment rising. That's when you're seeing a crisis. And therefore, the potential devaluation of the US dollar comes hand in hand with crises. So people essentially point towards gold as being a major haven and saying, you know, when the world's falling apart, everyone goes to gold. Well, yes, in part because the reaction from the central banks is to ease. And that reaction is what drives the expectation for gold. And certainly the movements that we've seen over recent years highlight that, really, because we've seen gold doing well during a period that we've seen elevated interest rates. And part of that is in line with the expectation of where we go from here. And that's why this time has been very well telegraphed compared to previous occasions, because the raising of rates came not necessarily in the face of a weak economy. Instead, it came in the face of strong inflation. And the idea was at some point inflation was going to come down. And that's when we see the rate cuts. Whereas this is very different to previous occasions where, you know, 2007, 2008, we didn't necessarily know we were going to have this big crisis on our hands. And soon enough it was. And the rates are cut. You don't necessarily know when that's going to be reversed. Now, this is another key market, and certainly this is something worth watching out for at the moment. But from a historical perspective, copper is a really interesting one as well. Known by many within the markets as Dr. Copper. The reason for it is copper is essentially like a doctor. It will tell you how the economy is doing, right? And so that should mean that copper does well when the global economy is faring well, and copper does poorly at times when the economy is under pressure. Now, certainly if I get rid of my head here just to make sure that we can see all of this, certainly if you're looking back over these three rate cut experiences in the past, what we can see here is that copper doesn't necessarily get going always at that first rate cut. Instead, you often see the economy trying to recover, right? It's the same kind of thing we were talking about before. As we've seen on these previous occasions, see the rate cut, then we see the surge in terms of unemployment. And around that peak in terms of unemployment, just at the time when markets are told the worst is over, that's when you start to see copper really starting to gain traction. It's not the case on all of these. That 2007 period, we saw the bottom come earlier, and essentially unemployment topped out sort of halfway into that recovery. But certainly on those other two occasions, we have seen that spike in terms of unemployment. And when we start to see unemployment rolling over, then that's when we see copper doing well. What's the example that can be gleaned for where we are at the moment? Well, essentially the question mark is, do we see that surge in terms of unemployment? If we don't, and if the soft landing holds, then you're looking at the potential for a potential breakout for copper. The caveat, well, copper is typically the kind of thing that everyone looks towards China to be one of the main consumers of, and certainly China is in a bit of a mess at the moment, and therefore you do have to take into account the sort of global outlook in terms of demand for the metal. But certainly the idea is, the moment that markets realize that the worst is over from an economic standpoint, that's when we see copper breaking out once again, and certainly metals are going to be key going forward. This is the Russell 2000 against the Fed funds rate. Now, bear in mind that the Russell 2000, of course, tracks small caps within the US, and we know full well exactly the trajectory over time that comes with the big growth names, right? Generally, they lead the market. Not always the case when it comes to the Russell 2000. The Russell 2000 can do well in certain periods of time and poorly in other periods of time. Certainly when you're looking at an economy that is really under pressure, those small businesses that perhaps aren't as well capitalized, they're likely to underperform. When you're seeing a period of time like we're seeing in terms of rate cuts, the cutting of interest rates is particularly keen for those within the Russell 2000, and it's highlighted here because 40% and growing, this was in 2023, so the number could be higher now. The 40% of the companies in the Russell 2000 have negative earnings. So essentially, creeping up on half the Russell 2000 do not make profits. What happens when you don't make profits? You rely on borrowing. And when you have high interest rates, those businesses are going to be under pressure, because the longer that they don't make a profit, the more borrowing they have to do. And the higher the interest rates, the more that it's going to be a burden on their balance sheet. So as we see those interest rates rolling over, and so we see rate cuts, there's an expectation that the worst is over for the Russell 2000, and we start to see it potentially outperforming as we go forward. So generally, you'll see this same kind of thing playing out as we've seen with some of these other markets, where firstly, you'll see those rate cuts, but we want to see that the economic crisis is over. Taking it in the context of where we are at the moment, the question is, what's the perception over whether there will be an economic crisis or not? If there's going to be a hard landing, it's not going to be good for the Russell 2000. But if we see signs that it's a soft landing and rates continue to be cut, then there's an expectation that we'll see outperformance for the Russell 2000 against some of the other stocks, in part just as a catch-up play because of the idea that people have been very fearful in the past over the potential for these businesses to essentially go bust. And so it's a catch-up play that we're talking about here. As we can see here, in terms of from a historical perspective, after rate cuts, we do generally see outperformance for the small caps, certainly over the 12-month time frame, marginally over the 6-month time frame, and significantly over the 3-month time frame. So you can see generally the Russell 2000 not necessarily in a bad shape. Now, this brings me on to the idea of where you're going to see strength in terms of different sectors. So we're talking about small caps, right? And small caps, there's an expectation that as long as we don't necessarily see a major economic downturn, rate cuts are particularly good for the Russell 2000 and small caps, or businesses that are heavily reliant on borrowing and are not profitable, right? This is another area that we're looking at, and this is the housing market. Of course, as you see interest rates being cut, so mortgage rates roll over. And when you see the mortgage rates roll over, you're expected to see home purchases increasing. So there's an expectation that home builders will benefit from lower interest rates, of course, because it sparks demand for their product. If we're looking in terms of the rest of the economy, though, it's not necessarily that clear cut what's going to be the big outperformer. You can look at the growth side of the story and say, okay, big tech names, they could be the underperformer because in the past they've outperformed for so long. And now we're seeing rate cuts and, those companies that are borrowing, of which big tech are not, they have huge cash piles. The borrowing companies are now going to really feel the benefits. That is the case. But at the same time, when we see interest rates being cut, so the desire for people to hold these fixed term assets diminishes. If you can get a guaranteed 7 or 8% or 5% over the course of a year, that might be attractive to you instead of putting your money into stocks. But as that guaranteed or risk-free rate of return declines, so you want to put your money to work. And where would that go? Well, it may go to the Russell 2000, but more likely it's going to go into perhaps an ETF. Perhaps it's going to go into an S&P tracker. Perhaps it's just going to come into the biggest names that you know. And by and large, all of those are going to be heavily weighted towards big tech. And therefore, big tech remains a key factor that, again, a key area that is likely to outperform. And generally, it's talking about what the strong companies are of that time, what are the market leaders of that time, and what are the big growth names where people can believe they will continue to grow going forward. For the rest of it, it's a question around the strength of the economy. Rate cuts don't necessarily mean a strong economy. And so it's really a case of tracking the economic data as we go forward and understanding exactly what position you see the consumers in. Will consumers continue to struggle under the weight of inflation? Whilst inflation has come down more recently, we've seen the prior boom in terms of inflation mean that many people have been priced out of buying the high value goods as perhaps their wages haven't caught up despite the aggregate figures that you see in terms of wage growth. And so the question mark of the health of the consumer and the ability to buy the goods of the businesses in the middle of this whole mix of companies is going to be really key. You can look towards specific sectors and say, I think this commodity is going to be doing well, and therefore this company should do well because of it. We can look towards precious metals, as I've highlighted, and say, well, this company essentially mines gold, and therefore I think they look an attractive proposition. Or you can look at, say, a miner that deals with iron ore or copper. They're very pro-cyclical. So that might be a case of the businesses doing well once we see the underlying price of their commodity gain ground. But that might come down to the period where we actually see the booming economy, which might take time. Remember, interest rate cuts don't necessarily immediately feed through into the economy and suddenly make everyone spend more money and businesses hire more people and invest more in their product. And so it takes time for things to feed through. So when you're looking at the potential sort of wealth of companies out there and who's going to benefit, generally stocks do relatively well once we know the economy is doing all right and that we see interest rates being cut and essentially a loose monetary policy stance. But that doesn't necessarily mean that all businesses are doing that well in the underlying metrics. You've got to try and find what specific parts of the economy and what specific commodities perhaps or markets perhaps are going to be doing well, and try to see what companies might benefit from that. So certainly when we're looking from a sort of sector, a specific breakdown, it's not necessarily as clear as saying interest rates are being cut, therefore all equities move towards the upside. And certainly when you see record highs in terms of some of these major indices, that doesn't mean that every single company within it is at record high or heading towards a record high. Some of them will continue to struggle, and certainly the ability to ascertain exactly who's going to benefit from interest rate cuts and who will continue to struggle is part of being an investor. I hope this has been useful to you, and certainly it's something that is going to be a key topic as we go forward, as people essentially try to ascertain whether we're going to see more rate cuts or less rate cuts and what the effect's going to be. And also trying to understand whether the economy is in good shape or whether we need to be fearful about the kind of deterioration that we have seen in the past following many of the historical rate cuts.